bring in our next guest with some breaking news. Jenny Horne, I got 2 words for you. In line, I'm guessing.
In line would be correct, Tom. Yeah, the exact read that we were estimating yesterday. So I will say, not the most exciting of numbers, but this doesn't change the narrative because I do think that we're still seeing a lot of the same readings as far as like inflationaries and reads on really what the Fed is going to do next. So I do think that right now coming in line with a 0.2% increase on a seasonally adjusted basis for October is an interesting figure. I think it's especially interesting when you look at some of the obviously individual components of CPI, like the index for shelter, which rose around 0.4% in the month of October. That accounts for more than half of the monthly all items increase. It used to be around 2/3, so actually consider that maybe we're seeing that moderate. But the food index also did increase over the month, rising around 0.2%, as the food at home index also did continue to rise about 0.1%, and the food away from home also rose 0.2%. The energy index was actually unchanged over the month after declining about 1.9% in the month of September. The index for all items less food and energy rose around 0.3% in October, as it did back in August and September. Indexes that increased overall: you have shelter, used cars and trucks, airline fares, medical care, as well as recreation. But the indexes for apparel, communications, household furnishings, and operations were among those that actually decreased for the month. I do think shelter has become one of the most, if not arguably the most important read of this report. So we are still seeing that relatively elevated, but the all items index did still remain up about 2.6% for the 12-month period ending through October, after rising around 2.4% over the 12 months ending in September. So the all items less food and index was up 3.3% over the last 12 months, which is why as consumers, I do feel like we are still very much in this inflationary environment. But the energy index actually is down 4.9% over the last year. So the food index increased about 2.1%. So there you go. That's why it still feels like you are paying too much for food. But I don't necessarily see that in completely moderating, I mean, at least in its entirety, because inflation has been the biggest read of this report, Tom. That's not really different. I think then the question is more rate cuts. Could we see the Fed sort of seize these rate cut patterns? I think that that's why CPI is so important, is everyone wants to get a read of what the Fed will do next, if anything.
Yeah, Jenny, they've been calling for, the shelter component to fall. I'm like sitting there scratching my head going, well, if there's not enough supply out there for people, rents and, insurance is going up. I mean, if there's not enough supply, how can shelter costs start to come down at this point, because the economy is still doing pretty well, jobs market's still doing pretty well. I just don't see that turning.
I don't either. I mean, I think that right now you have companies that are making an arm and a leg off of a more supply-constrained housing market. I mean, you see a read from home builders, you see a read from Home Depot this week. Seemingly, the people are still able to buy homes. Maybe they're just not. I mean, I think there's a major lack of affordability, but I don't see that moderating either. And I actually think it's unbelievable that now for a lot of these major metropolitan areas, we're seeing rent for the first time, I mean, I think ever, become cheaper than buying. But I will say the overall speculation of now, because of this one economic data point, I mean, people on Twitter this morning I'm seeing are like, well, now, like, are we seeing inflation start to creep up again? I do think it shows the overall volatile nature of inflation easing, and so I don't think it's going to be a clear-cut path, and that we can start saying that the Fed's either doing the right thing or doing the wrong thing. This is just one economic data point, and it was, I mean, honestly, as boring as it could be, because it was exactly what we were expecting.
Yep, stocks popped, yields falling on this report, dollar weakening a little bit also. But let's pivot over to some earnings names, Jenny. CAVA, have you been to the Mediterranean restaurant chain? Because it seems like investors are piling in. This thing's hitting all-time highs in the pre-market.
It just goes to show it's amazing what a name that's up. I mean, as substantially as this one is. I believe it's up over 330% over the last 12 months. So it just goes to show you don't always have to miss just because the bar is set so high, or because Chipotle and so many of these restaurant peers have missed. It's been a pretty volatile typical earnings reaction move for a lot of these restaurant-exposed stocks. But I have been to the one in Chicago. I cannot say I can give it a glowing endorsement because it was so crowded, but they had just opened. So I think it was actually their most successful opening in any major city anywhere, which I can speak to because it was a bit chaotic. But I have to go back when, frankly, it's not as maybe busy, but overall, third quarter results, there was a lot to like here. I mean, you saw revenue growth of around 39%. You also did see continued guest traffic growth up around 13%. Margins are improving. And I think the fact that they can give strong same-store sales and a strong same-store sales outlook right now is huge. That is not the same trends we've heard from so many of these other fast casual names. So, yeah, 39% jump in revenue is amazing. And I think adjusted EBITDA was a 69% year-over-year increase. Their new net openings is around 11, bringing their total restaurant count to around 352, a 21.4% increase year-over-year. They do expect to maintain that nice pace of around 12 to 13%, and they're targeting around 1,000 new locations by 2032. So seemingly on pace to do so, and I think that the unit growth as far as restaurants at least 17%, they have to maintain that rate. They said is very much doable. So they are growing and not showing signs of stopping anytime soon.
Yeah, I just don't get it, Jenny. I live in the city. If I'm not going to Chipotle, I'm going to the taqueria down the street. I'm not going to CAVA because there's a great Middle Eastern restaurant, or 10 of them, right down the street from me. So maybe I just don't get it. Maybe this is a suburb thing at this point. But
I think it is, honestly. I really think it is.
Traffic improving there. So great numbers out of CAVA. On the flip side, we got Instacart. That's falling, but pretty decent report out of them also.
Yeah, and I will say it's amazing how that these delivery services are able to all collectively do well. I mean, I know that they're somewhat different. They actually have partnerships with like an Uber Eats, but I do find it amazing that like DoorDash doesn't seem to be like a major threat as far as their earnings were concerned. I mean, they blew past forecasts, 42 cents a share on earnings, well above the 22 cents per share expected. And also revenue was around $852 million. That was a more modest beat, but they did actually cut their guidance, which I think that is something obviously to consider. They're right now trying to integrate some more streamlined shopping, they said, to drive this future growth. They did also launch at least one new service during the quarter, which they did highlight as now they're seeing more alcohol delivery and loyalty integration. Seeing their sales, they're saying, grow twice as fast with some of these major launches. So I do think that one of the most important indicators of growth is how many of these retailers and various platforms they can have on their own platform, and that has been huge. So I mean, more modest, I'd say, guidance going forward, but we've seen these names get absolutely punished on earnings. I mean, they're all volatile. Uber, DoorDash, Instacart, they're no exception. So I think that, lowering guidance, sure, but there was still a lot to like about this report, and this is still a growing company. So I give them some credit because, as we know, delivery, it's cutthroat out there.
It is. Bar was high going into this report also. Stock was at all-time highs going into it. So maybe a little bit of profit taking here, but still a great report. All right, great breakdown for us. That's Jenny Horne, markets correspondent here on the network.